Joining our closing bell exchange, Kelly Connolly from JHS Capital Advisors, Rich Peterson from S&P Capital IQ, Ken Mahoney from Mahoney Asset Management, John Manley from Wells Fargo Funds Management, and our own Rick Santelli. Welcome, one and all. Kelly, I want to start with you because you've made the case that now is a good time from where you see it to take some profits. That's different from the views of a couple of our other panelists, which we'll get to in a moment. Why do you say that?
Well, I think that we have to factor in some behavioral finance into the equation here. I do expect a pullback. We're going into the summer months, which is typically very slow for the market. On top of that, we've got the midterm elections coming up. And given the conduct of the government over the last several years, I expect more turmoil and more volatility, and the market doesn't like uncertainty. We're in the fifth year of this bull market. So I think that as far as the economic news, we've heard as much good economic news as we're going to hear for a while. And so I think that people should take some profits off the table. And I am a big advocate of asset allocation. I like the short to intermediate term bonds. I think you should keep it low duration, but I think there's some good value there.
Ken, a couple of key developments in the last 24 hours, and that is, by the way, totally aside from Iraq, which we'll get to in 1 second, you have Intel coming out, shocking markets, frankly, by saying that it is seeing some strength in business spending on PCs, and then you have Priceline splashing out $2.6 billion for Open Table. How do those two things change the dynamics here of markets, if at all?
You know, the market's going to remain choppy here, no doubt, but still an upward bias. And we have to kind of look at that old adage that's still working for investors. A trend is your friend. And until that's broken, you know, we kind of have to stay with it. Look, the biggest story of the year so far is a low volatility, at least coming into this week. We see how quickly that can change, how quickly volatility can change. But even with the added volatility, look what's happening. We have a lot more M&A activity. You have this monetary policy around the world supporting local markets. And on top of that, you know, you have pretty much a trend that's intact. So, you know, at this point, we just kind of stay the course, realizing we can take some incremental gains here and there. But at this point, the bull's case is pretty strong.
John? Yeah, even though, by the way, in Britain, sorry, Tyler, I was just going to say, they're not quite going to be quite as supportive over there. I mean, Mark Carney just came out and said that, you know, sort of sounded the message, listen up, you know, they're going to have to do more to raise rates.
Yeah,
Ken, never mind. Go ahead, Tyler.
I was going to turn to John Manley and get him to address what Kelly said about seasonal issues, the impending midterm elections, the idea that a lot of the good news is already in the prices, and yet you say that the market and some of the fundamentals that were relatively poor a year ago and went to better now can go from better to actually good, and that's why you see the future looking a little brighter.
I still think it's okay. I mean, you know, seasonality, you can always talk about seasonality, but quite honestly, I wish it were that simple. I mean, there's always Phillips on everything when it comes to this sort of thing. And let's face it, with technology, the summer's not the summer anymore. I'm still connected even at the beach, so I don't think things slow down that much. You know, it's the fifth year of the recovery. Last year was the fourth year. Next year might be the sixth year. These things go on longer than people think. The fact is the Fed is still accommodative, and they're going to stay so for a while. The earnings numbers are still coming through, and the valuation's okay. You know, that seems to be okay. We can actually go from okay to good. You can still make money as things are in the good territory. So it's not quite as fresh and as snappy as it was a year ago, but everything else is in place.
Rich, what do you think here? What do we need to watch?
Well, you know, I'm going to join the chorus with John and Ken and my other colleagues on the panel. You know, the fact is, you know, we're seeing positive numbers in terms of earnings. Valuations look reasonable. M&A activity is very robust. But really, well, the anchor of it all is like the accommodative Fed. You know, we'll have the commentary next week from Janet Yellen at the FOMC meeting. You know, the past 2 out of 3 scheduled meetings, the weeks for those meetings, the S&P has been positive. I think, you know, going forward, you know, we're going to see incremental gains in the economy. Hopefully, we'll see improvements in industrial production on Monday, housing gains maybe on Tuesday. You got the Philly Fed on Thursday. So all in all, you know, it's a catalyst for a better improvement. But really, you know, in the upcoming weeks, we're going into the twilight zone, and that means we're sort of ending the first quarter reporting period, and we're not going to see the second quarter earnings coming until sometime in early July. So that time, there's a lot of things holding the market captive, which much could be geopolitics.
Rick Santelli, jump in here. Fed next week. What would you like to see? What do you expect to see?
Well, I like what our one guest said. the trend is your friend. And I would just like to add, especially when the Fed is part of the trend. And I think that really dovetails nicely into the notion that we will learn on Wednesday, of course, if there was any changes. There shouldn't be. Janet Yellen's pretty much following the roadmap that was left by Ben Bernanke, whether for good or for bad. We're going to probably see more taper, and eventually we'll move more towards what Carney may have hinted at. And I think what Mr. Carney talked about from the Bank of England on that talk the night before last is super important for a number of reasons, because many look at the world as multi-speed. You have the U.S. and the U.K. moving one way. You have stimulus in China, Japan, and Europe. I don't necessarily look at it that way. I think all stimulus is fungible, and I think that the relationship I would pay most attention to is how the gilt yields running up to the highest levels in April at 275, how it affects the relationship between boons, tens, gilts, and the Southern European securities. I think those relationships will keep you out of trouble in one of the few markets that still has price discovery of sorts, and that is the global fixed income market, and only of sorts, of course.
Well, I wonder, Kelly, if what John Manley's saying is the case and that the summer isn't really as relevant in the way that it used to be, then what accounts for the fact that volumes have dried up in equities lately?
Well, I think that the global markets, people are putting maybe some money in emerging markets. I think there is some enthusiasm. I think overall the market looks good, but I think in the short term, we are going to see some volatility because of some of these issues coming up. I mean, we saw what it was like in the last election. There was a lot of uncertainty. I still feel that now would be a good time to take some profits and just kind of either sit on the sidelines or reposition a little bit. But I do think over the long term, the prospects for the market do look very positive.
Ken, you mentioned, and I would note that of all the stories that have taken place for the first 5.5 months of this year, the one that stands out to me has been the pace of M&A activity. Do you expect that to continue, number one? And number two, apart from what it may mean in individual sectors, is that a constructive thing for the market more generally, and if so, why?
I think so. Look, I think it's going to continue. There's still some value out there. Companies are not growing their top line, so they can't grow their top line. What do? They try to shrink their expenses. One of the best ways to do that is merge with one of their competitors. Now, on your second question, I think it bodes well. It's supply and demand. You're taking some supply off the market. So I think the M&A activity is very strong. And if you look back at markets that have performed very well in years past, we had a lot of M&A activity. So that's a pretty high correlation to what we're seeing right now in this market.
I say also the other factor too is the activist investor. We haven't talked at all about Carl Icahn this week. Probably wishing him a happy Father's Day. But the fact is, he made the announcement that they took a stake in Family Dollar store. The activist investor is still going to be a driving force in deal activity going forward.
Here's an interesting thought. I mean, we talk so much about overvaluation in the tech space, but it's some of these consumer names where we're really seeing the premium.
Yeah, I mean, I think the bargains you're going to find in the mall is not buying your shirts or your suits. It's going to buying the companies. So we heard the announcement today from Sycamore Partners that took a stake in some retailer out there.
Yeah, it's funny, John, because who would have thought, right? Consumer discretionary is the poorest performing sector of the year. We're talking about troubles, problems with the U.S. consumer. Top line isn't growing, and yet in the very consumer space and consumer staple space, by the way, there's been so much activity.
Well, the staples are very predictable, and people pay for that. And I don't think that's necessarily wrong. I think it's worth noting when you come to really high growth stocks, they very seldom blow up forever because the valuations went bad. It's usually the fundamentals going down. And this seems to be purely a valuation correction, and those things are very ephemeral in my memory.
Wow.
John, you mentioned, or one of my notes indicated, that you think that investors are less scared than they were a year ago. This week would suggest that maybe they have more to be scared about than they were a week ago.
And then they could become very much more scared, but down 5%, not down 20 or 30%. One of the keys of bull market corrections is they're nasty and brutish and short. They're like Hobbes. They happen very quickly. They come out of nowhere, and that's because the sentiment, when it turns positive, has no deep roots. People are easily uprooted in their positive sentiment back to where they were a year or two ago.
All right, folks, thank you very much, one and all. We appreciate it. Fathers, have a great Father's Day weekend, and everybody have a good weekend. Kelly?